Hello students, welcome to the brief description of the topics that are going to be covered during week 3. During week 3 I would be covering about preparation of final accounts, that is I will be taking few illustrations and I'll be explaining you how to prepare final accounts both in horizontal and vertical form. During day 1 I would be covering about preparation of final accounts of companies in vertical form as per Companies Act of 2013, and day 2 I'll be explaining you about window dressing, day 3 also about window dressing, and day 4 and day 5 will be numerical problems on company final accounts. So now during week 2 I would be covered about what is final accounts, how it has to be created. So as all of us know, double entry system of bookkeeping is considered to be a scientific and the most accurate system of recording business transactions, and under this systems there are three distinct stages to record the transactions completely. In first stage we will record transactions in the journal, which is considered to be the first book of entry or original book of entry. And in second stage we will record transactions in the ledger through a process called posting, and the ledger is considered to be the book of accounts where various accounts are normally maintained, and this ledger is termed as final book of entry. And in third stage we will prepare trial balance for ascertaining the arithmetical accuracy of ledger account balances. When once the arithmetical accuracy is verified, business concern will proceed to prepare final accounts or financial statements. So why these financial statements have to be prepared? Financial statements are required to be prepared by all business organizations at the end of the accounting period, and this final accounts will provide most valuable accounting information to all the parties who are interested in the affairs of the firm, like management, shareholders or owners of the company, suppliers, customers, lenders, the employees, the consumers, government authorities, and also the general public. These financial statements will help management to ascertain the progress made by the business from one period to another period. Thereby future course of action can be determined by the management. And for shareholders, it helps in knowing the profits and solvency position of the organization, and shareholders can assess the future prospects for their investments. Why creditors requires this information? They can understand the solvency position of the company for repaying its debts. And why employees require it? Because they will understand the profits and the stability of the organization for paying them the fair wages. And why consumers are required to know about the financial statements? To understand the cost of the product and what percentage of profits will be added by the firm, whether they have been made to pay the correct and the competitive prices for the products that they buy from the particular concerns. And finally, not but the least, the general public or the society at large will know the stability of the business organization and its contribution to the society. So these are the reasons why different parties involved in the organizations, directly or indirectly, require to require the financial statements of the organization, and hence it is necessary for any organization for preparing the final accounts or the financial statements. For that purpose, preparation of final accounts, the business organizations will be classified into trading and non-trading or the manufacturing concerns. What are these trading concerns? They are those concerns which purchase finished goods from the market and sell it at some profit percentage. They will not undertake any manufacturing activity, and such kind of firms, in the course of preparation of final accounts, they will prepare trading account, profit and loss account and balance sheet. So that is what I have shown here. So I will be discussing what is trading account, what are profit and loss account, and what is the balance sheet. So it involves so many headings under each account, that is trading account. While preparing trading account, we are interested in finding out the gross profit or gross loss incurred by an organization, and while preparing profit and loss account, we are interested in finding out net profit or net loss, and hence we will prepare the balance sheet, that is we will try to find out the position of assets and liabilities of the organization as of that date. So now we are interested to prepare final accounts, and it is not that easy to prepare final accounts. There are some adjustments that need to be considered or incorporated while preparing the final account. So there are so many adjustments that is in order to ascertain the arithmetical accuracy of the books of account, trader has to find out trading result of the financial position of his business at the end of the accounting period. Okay. So for that purpose, we will prepare final accounts, and trial balance is considered to be the tool with which trader will prepare his final accounts. But trial balance cannot be the total or complete tool for preparing final accounts. Why? Because the trial balance contains only those items which have been already recorded in the book of accounts, and there may be some items which is not contained, or which trial balance does not include such items, like it may be outstanding expenses, prepaid expenses, outstanding incomes received in advance, non-cash expenses, maybe examples are depreciation on fixed assets, interest on capital, and non-cash incomes would not be included in trial balance, which includes appreciation of fixed assets, interest on drawings, anticipated losses like reserves on bad debts, reserve for discount on debtors, anticipated gains like reserve for discount on creditors, etc. These items would not be there in the trial balance, and unless these items which belong to that particular year in which final accounts are prepared are taken into account, it is difficult to ascertain the correct trading results and financial position of the business. That is why adjustments in respect of these items are essential for preparing final accounts. So now what are these adjustments means? Adjustments means bringing into record of all those items which have not been included in the trial balance, like bringing into records all those items of expenses and losses, incomes and gains of the current period that have not been recorded in books of accounts. So what are adjustment entries? The various adjustments in final accounts are effected by means of journal entries. Such entries pass for the adjustments at the end of the trading period. They are called as adjusting entries. So the normally adjusting entries are passed in subsidiary books like journal proper, or we can call that as proper journal. So what are the objects of adjustments in final accounts? The objects of making adjustments is for including all expenses, losses and incomes which is related to that accounting period in the final accounts, and to exclude such items of expenses, losses or incomes and gains that do not relate to that accounting period. So, and without these adjustments, the results would be misleading. So, that is why it is important to incorporate the adjustments in the final accounts. So, some of the objectives why adjustments are required are for ascertaining the true profit or loss of the business, for ascertaining the true financial position of the business, to make a record of the transactions that are omitted in the books, to rectify the errors committed in the books, to complete the incomplete transactions, to make record of such incomes which have been earned but not yet received or not yet paid, to make adjustments of incomes that have already received but not yet earned, to make adjustments of such expenditure which have been paid but not yet incurred. Okay, these are some of the objects of adjustments in the final accounts, and Some of the important adjustments that usually occur are adjustment of closing stock, outstanding expenses, prepaid expenses, outstanding incomes, incomes that are received in advance, bad debts, reserve for bad and doubtful debts, provision for discount on debtors, provision for discount on creditors, depreciation, appreciation, interest on loan, interest on capital, interest on drawings. These are some of the adjustments that need to be taken care of while preparing the final account. So, I will be explaining how these adjustments are treated in the final accounts while discussing numerical problems, and we also have to prepare company final accounts. So, financial statement of company includes income statement, balance sheet, notes to account, and also the cash flow statements. So, now what is this income statement? So, the income statement is prepared to ascertain the results of the business, that is, what is the profit made or what is the loss incurred by the business during a given accounting period. So, some of the so we have to follow certain format for preparing income statement as well as the balance sheet. So, students, I will be sharing you one more PPT which contains all these things in detail, and I will be pausing for a while till I share the slide. So students, as I already told you, according to Schedule 4 of Companies Act, the financial statements has to be prepared in vertical formats. So the financial statements of company includes income statement, balance sheet, notes to accounts, and cash flow statement. So you are looking at the income statement format that is that has to be prepared according to Schedule 4 of the Companies Act. So, and this income statement uh, contains net sales revenue for the year. Then from that we have to deduct cost of goods sold. When we deduct cost of goods sold, we will get gross profit, and the cost of goods sold also has to be prepared as per note 1 of the Schedule 4 of the Companies Act. Then deduct operating expenses and losses, and we will calculate operating expenses and losses according to under note 2 according to Schedule 4 of the Companies Act of 2013, and we will deduct so when we deduct operating expenses and losses, we will get EBITDA, that is earnings before interest, tax, depreciation and amortization. When we deduct this depreciation and amortization from EBITDA, we will arrive at EBIT, that is earnings before interest and tax. Deduct interest on borrowings. We also calculate interest on borrowings under note 3 of the Schedule 4 of the Companies Act. To this we will add non-operating incomes and gains, maybe it is interest on investment, profit on sale of assets, etc. And from that we will deduct non-operating expenses and losses, that is loss on sale of assets, etc. We will get earnings before tax. From this we will deduct taxes, we will get earnings after tax. We will deduct dividends and appropriations, and we will calculate dividends and appropriations under note 4. We will get retained earnings. For this retained earnings, we will add the opening balance of the profit and loss account. If there is surplus, we will add it. If there is loss, we will deduct it. we will get the closing balance of the profit and loss account for the given year. So now cost of goods sold will be calculated under note 1. So cost of goods sold, first item under this is opening. We will consider opening stock of raw materials. For that we will add the purchases of raw materials during the beginning of the year. Then purchase of raw materials during the year. Whatever the raw materials purchased during the year will be added and deduct whatever the closing stock of raw materials. Then we will add conversion expenses like wages, factory overheads, etc., and add opening stock of work in progress, deduct closing stock of work in progress. We will get cost of production. To this you will add opening stock of finished goods and deduct closing stock of finished goods. We will get cost of goods sold, which is added to the net sales revenue under income statement. Okay. We also have to calculate operating expenses and losses. So how to calculate this? What are the items that are considered while calculating operating expenses and losses? So we will consider administrative expenses like rents, rates, taxes, salaries, general expenses, audit fees, directors fees, establishment expenses, and selling and distribution expenses like it may be traveling expenses, carriage, outward advertisement, discounts allowed, warehouse charges, salesman commission, bad debts, and anything if the reserve is provided for bad and doubtful debts, that is added, and any old reserve that is given in the trial balance has to be deducted. And we also will add other expenses like preliminary expenses written off, and we will deduct operating incomes and gains like commission received, discount received, etc., and also cash operating expenses and loss. So we will arrive at cash operating expenses and losses. And under note 3 we will calculate interest on borrowings, that is if there is any interest on mortgage loan, interest on debentures that is been paid, and we will add any outstanding interest on debentures to arrive at interest on borrowings, that is added to the income statement. Then under note 4 we will be finding out the dividends and appropriations. So what are the things that are considered while arriving at dividends and appropriations are dividend paid, interim dividend paid, proposed dividend, corporate dividend tax, transfer to general reserve, transfer to reserve fund, transfer to sinking fund, transfer to other reserves. This reserves depends on the reserves that is maintained in the companies. So these are the things that are calculated in order to arrive at the income statement or in order to prepare the income statement. So I will be explaining each and every head in detail. Then we will prepare balance sheet. So as you are looking at, so the format of balance sheet according to Companies Act is as shown, that is we will prepare the vertical balance sheet. So heading is balance sheet as on, as we prepare balance sheet as on that date, this is how we will give the heading. And the different items under equities and liabilities are shareholders fund, share capital, reserves and surplus, and non-current liabilities like secured loans, unsecured loans, current liabilities. Some like here I have just mentioned short-term provisions. There are other current liabilities like bank overdraft, sundry creditors, bills payables, and so on. And under assets, non-current assets are fixed assets, intangible assets, investments, and other non-current assets. So I'll be telling you, since each and every item is that is prepared as per the notes. In notes it will be given in detail about what has to be considered. So I will be explaining you each note. So from note 5, that is note 5 belongs to share capital. So here we will consider authorized share capital, issued share capital, subscribed share capital, called up share capital, and if there is any arrears, that is calls in arrears, that will be deducted, and if there is any shares to be issued in future, the shares for future, that will be added to arrive at paid up capital. then we will add calls in advance, we will get the total share capital for the year. Under note 6 we will be calculating reserves and surplus, like we will be considering capital reserve, general reserve, sinking fund reserve, securities premium, and other any reserves that is been formed or created by the organization. Then we will add profit and loss account surplus, we will arrive at reserves and surplus. Then under note 7 we will calculate secured loans like mortgage loans, debentures, and if any outstanding interest on debentures, that will be added to arrive at the total secured loans. So under note 8 we will be preparing, that is we will be arriving at the unsecured loans, that is any bank loan without any security. If you have taken any bank loans, that will be considered here. Then any loans that is being taken from subsidiary companies and any fixed deposits from the public, all these will be considered to arrive at unsecured loans under note 8. Under note 9 and 10, so we will arrive at the current liabilities and provisions. So some of the items or headings under current liabilities and provisions are sundry creditors, bills payable, bank overdraft, unclaimed dividend, outstanding expenses, incomes received in advance, provision for tax, proposed dividend, corporate dividend tax, all these are considered for calculating current liabilities and provisions under note 9 and 10. And note 11 is for fixed assets. We also will arrive at the total fixed assets during the year, okay, be it land, building, plant, furniture, vehicles, any other fixed assets, and we will find out the total. So how to find out the net fixed assets is, first we will consider the value at the beginning of the year. For that we will make any additions during the year, that is if you have purchased any fixed assets, that will be added, we will get the gross block. Then we will deduct the depreciation charge during the year, and if there is any disposals of the fixed assets will be deducted. So we will get the total of total or the net block, okay. So that is the gross block minus the depreciation and disposals will give you the net block of fixed assets. So that is how we will arrive at various fixed assets in the balance sheet under note 11. Under note 12 we will arrive at investments. So companies would have invested in government securities, it would have invested in shares and debentures of other companies or any other kind of approved securities. We will consider all such investments and we will arrive at the total investments under note 11. So under note 12 sorry, under note 13 we will arrive at other non-current assets and miscellaneous expenditure. That is, we will consider preliminary expenses and we will deduct any preliminary expenses that is written off during the year, and underwriting commission, discount on issue of shares and debentures, profit and loss account, debit balance, all these will be considered to arrive at non-current assets under note 13. And note 14 consists of current assets, loans and advances. That is, we will consider cash in hand, cash at bank, sundry debtors, bills receivables, inventory, outstanding income, prepaid expenses, tax deducted at source, the loose tools, any advances, all these are the items of current assets, and we will take the total of the all these current assets in the balance sheet of an organization under note 14, and we will arrive at the balances of the assets and equities and liabilities as on a particular date. And students, I will be discussing about that is how to prepare income statement and balance sheet by considering suitable examples during our regular classes. There I also will be discussing about as I told you, under share capital we discuss about various other types of capital like authorized capital, issued capital, subscribed capital, called up capital, paid up capital. What are these capitals? So I'll be discussing in detail about all these while taking up or while solving problems. So now we also will be discussing about window dressing. So what is this window dressing? So students, we know that why we prepare financial statement is to provide this financial statement for various purposes of the parties involved in the business. So as I already told you, why creditors require financial statements, why employees require financial statement, why the investors require financial statement. So the requirement of financial statement for different parties is different. The purpose why they require a financial statement for different parties is different, right? So here business organizations requires funds or capital for running its organization. So how it gathers funds? It is by either by borrowing loans from banks or either by issuing shares, by issuing debentures, etc. There are various means and sources of finance. So but no organizations will get the sources, capital financial sources that is required to run very easily. Okay, so that is one of the reasons why this window dressing concept is in picture. What is this window dressing? It is an effort made by the management for improving the appearance of company's financial statements before it is publicly released. It is very simple. Okay, so it wants to showcase its financial statements attractive to the people who are involved in the business. That is why the organizations are interested in manipulating the financial statements for showing more favorable results of the business. So that is what is called as window dressing. So what are the purposes of window dressing? As you could see here, the purposes of window dressing are many. Shareholders and potential shareholders are interested in investing in the company if the financial look is good, correct? It is useful to seek funds from investors or to obtain any loan. Window dressing, it is useful for seeking money or any kind of loan, right? So that is also one of the reasons why window dressing is required. The stock price of the company will shoot up if the financial performance is good. Yeah, if the company is listed in the stock exchange, then if the financial performance of the company is good, as soon as the organization publishes the financial statements of either the quarterly, yearly or off-yearly financial statements to the public, depending on whether the financial performance is good or bad, the share prices will increase and decrease, and hence window dressing is required. Tax avoidance can be done by showing poor financial results. So if at all if you want to show the poor financial results, if you want to decrease the tax amount that is to be payable to the tax authorities, then the organizations will show the poor financial results to cover up the poor management decisions taken. So in the course of business, there would be decisions that have been taken are very poor or ineffective decisions would have been taken by the people that is at the managerial level. So this, if you improve in order to cover up this poor management or ineffectiveness in taking the decisions, they will consider or they will dress up or manipulate the financial statement. It improves the liquidity position of the business. Okay, when there is some manipulations made in the business, the financial statements, it will improve the liquidity position of the business to show a stable profit and results for the company. So it also, if there is unstable or inconsistency in the profitability of the company, so in order to show up the stable profit and also the consistency in the results of the company, they will manipulate the financial statements, and this window dressing is done to reassure the financial stability of the company to money lenders. Okay, so as every year there is a requirement of money to run the business, in order to reassure the financial stability for the investors or money lenders, they will go for window dressing, and it also is done to achieve targeted financial results. So as all of us know, we will be having targets. As a manager of each department, you will be having targets, and the target for the previous year, the target for every subsequent year will be more than the target for the current year, and hence window dressing is required. It is done to showcase the good return on investment. So it is also important to showcase the good return on the investment, and hence they will do the window dressing to cover up the actual state of business in case of business in nearing insolvency. So if the business is nearing the insolvency, it is required to cover up the actual state of the business, that is to not to showcase that the business is getting insolvency.